Have you ever noticed how some investments just seem to keep winning, even when the rest of the market is having a rough time? Most people chase after the trendiest stocks or try to time the next big tech surge. But what if the real secret to steady gains was hiding in a sector that's often overlooked? Healthcare S-REITs. This year, healthcare S-REITs have quietly outperformed the broader Singapore REIT market. While the main S-REIT index slipped by just over 1%, healthcare S-REITs delivered an average total return of 6.2%. Over the past year, that outperformance is even more dramatic, with healthcare S-REITs averaging nearly 17% returns. That's not just a lucky break, it's a sign of real resilience. So why are investors putting millions into these trusts, even as they pull money out of other real estate investments? Is it just about the world's aging population, or is there something more happening behind the scenes? And most importantly, how can you use this information to make smarter decisions for your own portfolio? Stick with me, because in this video, I'll break down what makes healthcare S-REIT so special, share the latest updates from Parkway Life REIT and First REIT, Singapore's two healthcare S-REIT leaders, and show you how these insights can help you grow your wealth. Plus, I'll explain the risks and the strategies you need to know before you invest. And if you want to go even further and get exclusive investing insights delivered to you every single day, you can become a premium member for just $1 a month. You'll unlock daily market analysis, early looks at promising trends, and deeper dives into investment strategies that can give you a real edge. Think of it as your daily dose of financial fuel. I'll tell you more about how to join after the intro. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025, and I also focus on both regional and global economic trends. Let's get into why healthcare S-REITs might deserve a spot in your portfolio. First, let's talk about what a REIT is. A real estate investment trust, or REIT, is like a basket that holds income-producing properties. Investors buy shares, and the REIT pays out most of its rental income as dividends. Healthcare REITs focus on properties like hospitals and nursing homes. The big advantage? No matter what's happening in the economy, people still need healthcare, which makes these properties more stable, even when times are tough. This year, healthcare S-REITs posted a 6.2% return, while the broader S-REIT market actually fell. Over the past year, healthcare REITs are up nearly 17%, and over 3 years, they've averaged 6.2% per year, while other REITs have lagged behind. Imagine two boats on a stormy sea. One is loaded with risky tech stocks. It's fast, but it gets tossed around. The other is a sturdy ship carrying hospitals and nursing homes. It may not be flashy, but it keeps moving forward, even in rough weather. You might be wondering if all real estate is risky right now, and that's a fair question. But healthcare REITs have long-term leases, often with built-in rent increases. Their tenants, think hospitals and nursing home operators, are less likely to default, even in a downturn. While shopping malls and office buildings might see tenants come and go, healthcare REITs enjoy steady, predictable cash flow, which is why institutional investors have put 17.6 million Singapore dollars into healthcare S-REITs this year, even as they pulled 527 million out of the broader REIT market. Let's take a closer look at Parkway Life REIT, or EP Life REIT, one of the largest healthcare REITs in Asia, with properties in Singapore, Japan, and France. The portfolio is worth about 2.46 billion Singapore dollars. In the first quarter 2025, EP Life REIT grew its revenue by 7.3% to $39 million, and net property income, which is the money left after paying property expenses, rose 7.5% to $36.8 million. That's impressive growth, especially in a slow market. How did they do it? They bought a new nursing home in Japan in August 2024 and acquired 11 nursing homes in France in December 2024. These new properties added fresh income, which helped offset the weaker Japanese yen. Plus, their Singapore properties have step-up leases, meaning rents go up a little each year, almost like getting a small raise at work. EP Life REIT's distributable income, which is the money they can pay out to investors, jumped 9.1% to $25 million, and distribution per unit rose to 3.84 cents, up 1.3%. That's more money in investors' pockets. Here's a smart move. EP Life REIT is selling its Malaysia portfolio, which is tiny, just 0.2% of revenue, for $6.09 million. Why hold on to something small and distracting when you can focus on your winners? The REIT's gearing ratio is 36.1%, which means they're managing their debt well. Even better, 90% of its interest rate exposure is locked in at fixed rates, so if interest rates rise, EP Life REIT won't get caught off guard. Analysts at Bloomberg have a 12-month target price of $4.70 per unit for EP Life REIT. That's a solid vote of confidence. Now let's talk about First REIT. This one's a bit different, as its properties are mostly in Indonesia and Japan. In the first quarter of 2025, things were a bit tougher. Rental and other income fell 2.8% to $25.4 million, and net property income dropped the same amount to $24.6 million. The main reason was currency. The Japanese yen and Indonesian rupiah both fell against the Singapore dollar, so even if the properties did well in local terms, the numbers looked weaker when converted to Singapore dollars. In fact, in local currency, the Indonesia portfolio's income actually rose 5.5%, and Japan's was flat, so the underlying properties are still performing. Distributable income fell 2.2%, and distribution per unit dipped to 0.58 cents. Not great, but not a disaster either. On the debt side, First REIT's gearing is a bit higher at 40.7%, and about 57% of its debt is at fixed rates or hedged, which is decent. The good news is their cost of debt dropped from 5% to 4.7%, and they don't need to refinance any loans until May 2026, which gives them breathing room. Here's something interesting. First REIT is exploring options for its Indonesia portfolio. They've hired a marketing agent and reached out to over 60 parties to see who's interested, and they're also talking to multiple parties about the business as a whole. This could mean a big change or a big opportunity in the near future. Analysts see First REIT trading at an attractive 9.2% yield for 2025. That's like getting paid nearly a dime for every dollar you invest every year. Plus, as more Indonesian hospitals hit performance targets, rents could rise. Bloomberg's target price for First REIT is 30 cents per unit. So what's the big picture here? Healthcare S-REITs offer stability because healthcare is a basic need. These properties stay in demand, even in tough times, and they provide steady, often growing income, with many having built-in rent increases. They're less sensitive to economic cycles, and when office or retail REITs struggle, healthcare REITs often keep moving forward. Let's wrap up what we've learned. Healthcare S-REITs have outperformed the rest of the market thanks to their stability and steady income. Parkway Life REIT stands out for its growth and smart portfolio moves, while First REIT offers a higher yield but comes with a bit more risk. Both have strategies in place to manage debt and interest rates, which is crucial in today's market. If you found this video helpful and want to level up your investing game with daily premium insights for just $1 a month, click the link in the description below to become a member. You won't regret having that consistent stream of valuable information that can help you on your financial journey. Don't forget to like, comment, and subscribe for more videos like this. And if you want to keep learning, check out my previous video on how to spot the next big REIT opportunity before the crowd. Thanks for watching, and I'll see you in the next one. Financial Journey.